Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is November 20th, 2025. And today we've got a little bit of an exciting sell-off going on. We've done this before, but this is almost a 2.5% day down in the NASDAQ and about a 3% in tech stocks specifically. You can see larger than even the sell-off that we had in October. Bigger day, bigger range, higher high, lower low, pushing down through here. And from the top to the bottom, we're talking about 28 points in the Qs. That's a big move. So we're looking at this and it's selling off to the 0% or the 100% level of the year. So that's a key monkey bar level for the year. I'm going to watch for a test there and a bounce there. We've bounced here before, rejected it here and rejected it here. So we could stabilize here. But the concern I have that I brought up in the main room earlier today is if the dollar gains while equities sell off, it shows that it's a flight to cash, not a rotation into returns like in bonds and utilities and consumer staples. However, that does not mean that I'm still not looking for returns in those areas. So we talked a little bit about KHC, Kraft Heinz, as a potential trade in those markets. We talked about Dollar General. We talked about those setups. I do want to cover a couple more in the consumer staples space. I like consumer staples here as a way to get a return on risk in dividend heavy stocks. And we'll start with one of the dividend aristocrats and a consumer staple stock called Coca-Cola. As you can see, Coca-Cola had a fine day. It's up 0.5%. It's stabilized in here. It also created a higher high, lower low in the individual candles. And even if you are looking at this and saying, I need it to break through the high to create this cup and handle, there's opportunity that Coke could go $3 to $4, which is going to be about a 5% move, and it pays a dividend. As you can see, the dividend is 2.85%. The next dividend is coming up. Ex-dividend date is December 1st. And so you could easily buy into here and collect that 51-cent dividend in the next 2 weeks. Perfectly reasonable trade and a flight to safety and a return that is stable in those dividend payments. If we look at the options, it's fairly inexpensive to buy the call. We're the 18th percentile implied volatility. So there's not a lot of cost to the trade. And that's part of the reason why I'm not looking to do a short put here, because the short put that's one step out of the money is only 1.35%. I think I'd rather own the stock and get that directional move that could give us 3 to 5% move and a 2.86% dividend yield annualized, which is going to be another 51 cents. So I'd like Coca-Cola simply as a straight up buy the stock, collect the dividend. Another stock in the space of consumer staples that I talked about last week that I like still is General Mills. I talked about it last week and said this is a decent place to buy off the lows and get that dividend, because it's highly discounted. I do think there's going to be some stability here. There's some low cost. They had good earnings, and I'm looking for this to return up to 51, 50, 51 in here. So there's still another 5% move inside of this as well. Now, the 5% move is attractive. I think you could trade that over the next couple of weeks and find some safety in there. And if you look at the dividend, it's a 5% dividend yield, and their next dividend is on January 9th. So we have some time for here as well. So January 9th, you could buy, you could own the stock, you could gain 5% and get into that dividend that is a 5% annualized dividend, which is 61 cents. This one, however, is reasonable to sell the put. If we don't want to just buy the stock and we would be willing to own the stock down at these lows, look at the current IV ranking, 82%, which means their premiums are very high at these lows. And if you look at the at-the-money option, currently at 47.88, 47.50 is the one step out of the money, and that's going to pay you 3.3%. So you get 3.3% for your willingness to own it at 47.50. You'd also get an extra 30-cent lower cost if it did assign at 47.50. So I think that's a reasonable trade. You'd be buying it with a cost basis of about $45.90, $46-ish. And if we look at the chart one more time, 46 would be the low of the year. So selling the put puts you in a situation where you can collect that 3.3% for being willing to own it. If it does fall back, you're in essence owning it with a cost price of the year's low. And then you still can collect those dividends. So selling December 19th at the money put, 47.50 and getting 3.37%. If you don't get assigned, you got 3.3%. If you do get assigned, your cost basis is as though you bought it for the end of the year. And if you get assigned, you just need to hold it for 2 weeks to get that next dividend. Another stock in this space would be Philip Morris. Philip Morris is sitting here in a consolidation pattern. Timing-wise, I could go either way on this, waiting for the breakout above the 160 or simply buying it now. if it breaks out of this, it is a kind of a weird looking inverse head and shoulders, so we could be looking for a move from about 142 to 160, and we're talking about a 10% move up. Now, 10% would be excellent. We could buy into the stock and just hold it. And if we look at the trade tab, that's a 3.77% dividend. The next dividend is likely early January. It's not showing up on the chart yet as far as their ex-dividend date, but likely January. Looking at the bottom, you can see it's 40% implied volatility. Anywhere between 35 and 50, I want to calculate. Above 50, I just want to be a seller. Below 35, I generally want to be a buyer. So that 40% says we might be able to get away with selling the put on Philip Morris. And if we sold the put at the money at 155, they're going to pay us $4. $4 at 155, it has to fall $1, and we get paid $4. So really, it's as though we're getting $5 below the current price. And that would put our break even about 151. If you look at the chart for 151, you'd have to reverse back to this low and break that support level. But you get paid if it doesn't move or if it goes up. If you do get assigned, then you start collecting that dividend yield starting January. This last one is deeply discounted. It's one that I would say that I would like to see some sort of confirmation, some sort of bounce. And the premiums we're getting on this aren't as nice as I would like them to be to sell a put. So we're going to walk through this and look at the dividend and the idea that if we bounce, we could go all the way back up and fill this gap. That's about a 10% move to get up to this gap. If we can stabilize here, it's tried, it's defended, it's defended. This is the perfect chart where I'd want to sell puts, but the puts just aren't going to allow us to pull this off. So if we take a look at the trade tab, one, it's a 3.58% dividend yield. The last one was September. So theoretically, end of December, early January is the next dividend, but we're not showing it quite yet. We look down here, the current IV rank is 46%. That would make me think I should be able to get a pretty good return at the money. At the money option, 55.87 would be 55, and it's only 1.66%. So it's not ideal as far as selling the puts. This would probably be one that after you see a little bit of a bounce, you buy the stock for the 10% move, you collect the dividend of 50 cents on the next move, which is 1% of the stock price, and let it go up to the next target. I'd prefer to have that implied volatility be higher. I'd prefer to have that put pay us out more at these lows, and I'm a little bit surprised there isn't more premium in that trade. And I would have looked at Target, but it's not setting up the way I'd like it to. I've talked about this before. I bet on Walmart, bet against Target. Bet on the discount stores like Ross stores and TJX and Walmart, but not on the premium, what we'll call a premium department store. So it doesn't surprise me to see Target miss and go lower. I think people are shifting. That's why Dollar General looks so good and Target looks so bad. So normally I would have looked at Target, but the premium is decent. The dividend is great, but the sell-off, the break below the low, and accelerating with good volume is a reason why we're not looking at Target as a consumer staples trade off the low. You could look at Pepsi to mirror Coca-Cola, and it's going to give a very similar setup. In fact, let's do that really quick. We'll wrap it up with Pepsi. Pepsi is sitting here in the middle of this consolidation. Not necessarily a great bounce, but it's certainly a good recovery off the lows of the day without putting lows to the annual lows for the year. If you look at the trade tab and scroll down, the implied volatility is 27%. That tells you you're probably not going to sell the put. You're probably just going to buy the stock and get that 3.89% dividend yield or play long calls or long call verticals. This one's okay priced. If you look at the money, it's 2.6%. I don't like trading anything under 2.5% at the money, but you could get paid $3.75 for the 145. That means you'd have to drop $3.75 plus the $1.10, $1.15. It gives you about a 4% margin of safety with a 2.6% return. So I like Coca-Cola a little bit better, but figured we'd just go ahead and analyze Pepsi with you today as well. Those are the trades. Those are the ones I'm watching. I'm looking for safety and returns in this crazy volatile market. And this is the place you're going to find it. You're going to find better dividends in the consumer staples, utilities, and healthcare sectors that are going to stabilize. Even if they slide down a little bit, they're not going to slide as fast as the rest of the market. These are the ones that are discounted. They've already discounted down, and now they're going to be of interest to traders as they want to find that stability and that return. That's going to do it for me today. Thanks for watching, and we will see you again in the TheoTRADE live tomorrow.